Okay, how exciting. I don't know whether to feel fear and trepidation or feel exhilarated because I am hosting this one. And we are chatting about API's property sentiment report. It was a great survey and we've been looking through the findings and we've got some amazing things to share with our listeners. But Mike's written the script, which is where the trepidation comes in. There's a lot of words that we might have to beep out here. I've just got to not get caught by his nasty trap. How are you going, Dave?
Yeah, I'm going really well, Cate. API, the Australian Property Investor magazine, is they've produced this survey and we're going to unpack it using some of Mike's scripting and some of our own thoughts as well.
You just have your finger hovering on that button, Mike. Let's give it a go for our listeners. There we go. Beautiful.
Cate just swore again.
How are you, Mike?
I'm going very well. I'm looking forward to this one. You know, API magazine, it's had a long and storied history, right? It used to be a magazine, and it was probably the biggest selling. I'm making that up, but I presume so. It was pretty highly credentialed, and it hasn't been a magazine for a long time, and now it's kind of privately owned, and you can see some of the advertising from the owners in there. But there's still some really robust stuff that comes out of it. I just read an article by the editor Craig Francis recently on rental freezes, so that's pretty cool. And we've also got some great industry buddies that have been, editors of API magazine, like Kieran Clare and Nicola McDougall, and Neela as well. Yeah, so there's been quite a few people that have gone through and made it a pretty cool publication. So I'm looking forward to their survey because it's been a source of education for property investors for a long time.
Has it ever? I love that you've paid homage to it. I remember getting my ex-boyfriend years and years ago to build me this amazing bookshelf that had the right height shelf for all of my API magazines, and there were post-its. It just goes to show, doesn't it? Some of this was really formative for us when we were looking at the back of the magazine and dredging up yields. This is long before we all turned to the internet.
I still have a real visual in our first office when we would get quotes and write stories in API magazine 15 to 20 years ago, and we had the magazines in their little holders in the bookshelf with the dog ears or whatever you call them on the pages that our quotes were on. When Neela was the editor, and we'd have a stand at the Home Buyers Show, and so would API, and Neela would be manning that stand, and the good old days when only magazines were how that sort of information was disseminated.
Absolutely. I remember the very first time I wrote in I was an investor then, I wasn't a buyer's advocate, and I sent in my story because we bought some property in Port Pirie and had this regional tale to tell, and they published it. It was really cool. And then when I was working as a buyer's agent in about my second year maybe, I had a story published that they'd picked up. It was a blog that we'd written, and I was beside myself. And it just goes to show how special it was for a lot of us.
Yeah, we used to get very excited when we got quotes in there, and
you scan it
article
on the colour scanner.
We should all dig up a copy that we were individually featured in and chuck them on the website or something. I'm making homework for us now.
I will. That'd be awesome.
Yeah. Just hope we can still find them.
I'm the same. It'll be in some drawer or some bookshelf somewhere. Like back in the day, you used to keep that stuff, and you're like, "Look, Mum, I'm famous."
Yeah, 20 years ago.
Getting your name in the paper for doing something well in sport.
Oh, too funny. Well, okay, let's crack into this. There are a number of property investor surveys doing the rounds these days, and they give a good snapshot into sentiment, perhaps sometimes a peek of what's to come. This week, we're going to unpack the survey conducted by API magazine, and the data collected was between the 26th of June 2023 and the 17th of July 2023 from 735 respondents. Dave, the first question from the survey was about investment type, specifically houses versus units. The gap in performance between the two has closed a little recently. Did that translate in the data?
No, not in this survey. In fact, houses are the preferred intended purchase over the next 12 months among 37% of the respondents. So that was a seismic shift from the mere 21% with that intention just 3 months ago. So I can only imagine that the swing has moved back towards houses because units have had quite a recovery in price growth over the last 12 to 18 months and closed the gap significantly between the median price of units relative to houses. So I imagine this is part of what's made them less attractive to would-be purchasers. We also know from the macro view that there is an ever-increasing amount of data suggesting that houses have outperformed units over the past decade or two. So, and this would be mostly down to land value increases over that time and the fact that houses on average have a greater land to asset ratio than units. So, look, it's also worthwhile keeping in mind that CommSec last year found that Australian US homes are now the biggest on earth, with the average floor space for a new freestanding home a whopping 229 square metres.
Oh,
so, yeah.
That's ridiculous. The old McMansion. My goodness. Mike, did the data surprise you?
No, not really. I mean, anyone that's been listening to this show probably before I joined would be learning about the land to asset ratio. So all sophisticated and educated investors would have been listening to this show. So they're avoiding units. And I think that the gap has only closed because units did get smashed during COVID, right? We had, 7-10% vacancy rates for a short period of time, and a lot of people were
13
really
in what? In Melbourne?
Yeah, there you go. So it just went crazy. And having a look at our data for the last financial year, we found that 54% of investors bought houses rather than 17% or just shy of 17% for units. So, houses always much more popular. I think people realise that the capital growth is more likely to be in houses. Now, as the price point changes and units are so much more accessible, that figure may increase. We're certainly seeing townhouses increase quite rapidly. And getting back to your point, Dave, what did you say, 220 square metres?
229 square
229
metres for just the dwelling.
The average gross floor area for houses in the last financial year for investors, we had at 145 square metres. So it shows such a big difference, and with townhouses 117 and units 88. So townhouses fit quite neatly in the middle. But yeah, houses perennially popular with investors.
Well, it's interesting. They've got used to that over the last 2.5, 3 decades, which is a long time. That's a lifetime of investing for a lot of people in their active, working and purchasing phase. But if we wind the clock back 30 years, nationally we had units outperforming houses for a while there, and we forget about that. And, are the drivers there for it to turn? I'm not suggesting that for a minute, but we've all been so conditioned to houses outperforming that everybody is saying now avoid units, buy houses. And it's a really interesting walk down memory lane when you do look at the data from 30 years ago.
Do you know, it got me thinking as well about, we know from our own experience that a lot of new houses are bought by first home buyers. And obviously there's the conversation about the cost of entry for first home buyers, but it would be really interesting to measure the average dwelling size for first home buyers today versus 20, 30, 40, 50 years ago, and how much that is actually feeding into, the disparity in the cost to enter because we expect more from our first home than we once did.
Yeah, very true. And look, in fairness to first home buyers, stamp duty is such a bitter pill to swallow. A lot of people talk about future-proofing now compared to when we first started purchasing. There was no talk about future-proofing. There was no doubt at all in my mind that my first property was not going to be my last.
Yeah,
not just because I'm an investor. We knew that we had to start. It was, a stepping stone.
Yeah, mine was a 2-bedroom unit, my first property that I lived in and bought.
Yeah.
My first one had a rat's nest. And, I wouldn't describe myself as hyper aspirational, but I did aim higher than rat's nests.
No words. Okay.
What, like inside of your house or
well,
underneath it?
As it turns out, I bought this place that was an absolute bomb, and the floors weren't level, and the carpets had animal urea issues, so they were kind of ripped out. And I bought it and convinced my flatmate to sort of to leave where we were staying, which was nice, view of the lake, to come into this bomb for I think the same rent, which is probably rude. Shout out to Kyle.
And you cop the tax deductions as well.
Yeah.
Worst flatmate ever.
Well, it's cash in hand and claim the deductions from that.
Yeah, had to pay a bit of CGT, but I worked it out. So we moved in, and I think 3 days later I went to Thailand for 10 days and just kind of left him to it. And then, I got a message from him, then it had quite a few in the mix. This could be a real thing, this button.
Do you know what, Mike? That's not that dissimilar to one of my stories.
You were horrible.
Well. My second purchase, I bought a townhouse and tried to convince my mate Dino, shout out to Dino, who I was living with, to come with me from the 2-bedroom unit to the townhouse, but he had to pay an extra $20 a month in rent, which I said to him was just one less bourbon and Coke a week. But he wouldn't have a bar of it and didn't move with me.
Oh, well, I'm grateful I had a Kyle instead of a Dino. Yeah, he discovered there was like one of those, it was in vogue years ago. It was one of those kind of fixed barbecues in the middle of the yard. The whole yard was overgrown, so we actually didn't know it was there at the beginning. And he decided he wanted to rip everything out and have a few bonfires with his mate. And I'm like, well, you can't make it any worse. Like, have at it. And then he uncovered this barbecue that had kind of been all mudded in, and it was just like an absolute. It was like rat Woodstock.
Right.
What a horrible party house that would have been.
Yeah.
Wow. We digress. Back to the program.
Oh, yes, the survey.
Yeah. That podcast thing. Another thing to note, which doesn't bode well for supply, is that the survey showed there was a marked decline in the interest levels of developers who, surprise, surprise, deterred by building sector cost woes, have declined from 16.5% to just 9% of those planning to procure a property. Mike, the pollies are talking a lot about supply at the moment, so how do you expect this indicator to play out in the market?
Well, you and I have talked about this ad nauseum about the issues with, there's the Senate inquiry into rent freezes. I know it's not called that, but that's sort of roughly what it is. And they talk about supply is the problem, right? And we know that is long-term the problem, but, moving the needle on supply is really only possible from, a short-term basis with investors participating in the market, because we can do all this build-to-rent things. We can have developers build these affordable housing things with tax concessions that the government's given them, but developers need to make money. So you can't just release land, or you can't give them some sort of incentive. If the numbers don't stack because construction costs are too high because of materials or labour, or because of the financial setting at the time, interest rates are so high that developers are a little bit wary about pressing the button on these projects. And you know what? A developer wants a constrained supply, right?
Yeah.
Because it's much easier to sell their stock. So you can't expect developers to be solving this national supply problem
totally
unless
agree.
it makes sense to them.
At what stage did our politicians ever stop to think that people are actually in this asset class for a profitable journey, not out of altruistic reasons?
Stop to think that.
They just think we're all here for altruism. Find me a developer that cares about doing something altruistic, and I'll do a handstand.
Yeah.
Yeah, well, the current government thinks like that anyway.
Yeah. Well, Dave, moving on to the next question. In asking survey respondents about what property transactions they'd made in the last year, the proportion of people saying they'd made no property moves in the past year soared from 13% to a remarkable 30% in just 3 months. What did you put this down to, and was it a surprise to you?
Look, it's a big jump.
No, stick to the script.
I won't swear just yet.
A bit too early.
Yeah, it suggests people are pretty reactionary when it comes to major decisions regarding property, and therefore they probably don't allow for enough buffer or wriggle room in their cash flow analysis for rate movements. in particular if they go up for a few percentage points, which is one of those things we're taught when we first start analysing, cash flows, add 2 or add 3%. It's what the banks do with the serviceability calculators to the current rate to figure out if it's affordable. But from my personal experience, most people rely on guesswork and bank serviceability calculations rather than conducting, thorough property planning analysis relating to their next purchase to ascertain, the cash flow with accuracy, allowing for rate rises and mapping out different purchase scenarios. So, having said that, obviously it's been a quite unique set of circumstances with the most rapid rate rises on record.
Yeah.
So overall, you definitely have to say that it is the interest rate movements that have caused this large fall. Some of this is probably potentially investors and first-time buyers putting off buying, but possibly the largest cohort impacting this number could be the upgraders, given the steep jump in cost when taking this step. And just interestingly, this might be reflected in the financing numbers that came out last month, which showed investors and first-time buyers as a percentage of all purchases increased, but that also essentially says that upgrader numbers have been falling.
Yeah, without a doubt. Mike, of all the people that did pull the trigger, what did the survey show about those?
Well, they just absolutely went for it. So 70% of the respondents who transacted in the last 12 months, 63% of those bought more than one property. And anyone that is in a financial position to transact on property in the last little while, or let's just say people that I know have a reasonable financial backing, they're seeing it as a huge opportunity, right? So I think for investors that are looking for their first property or their first home buyers, they're investing in a more typical way, and that is the market conditions are favourable to them. But the ones that are a little bit more sophisticated and have the ability, I should say, to purchase when the conditions are poor, they're capitalising on those opportunities. So many people that I speak to that are sophisticated investors, they're wanting interest rates to continue to rise. So they've got less competition in the market. They want, property prices to be as soft as they can, because from a macro view, all the fundamentals are still so positive for property. We've got massive shortages. We've got crisis levels of rental yields. Yes, we've got a pretty unfavourable political environment, which comes up in the survey a little bit later. But, people that can are getting stuck in.
Yeah, that's really interesting, Mike. While intentions don't always equate to action, more people do seem intent on transacting in property in the coming 12 months. But, caution is still out there. Last year, almost 3 times as many respondents as the previous quarter said they plan to sit on their hands when it comes to property. So we do have some different camps out there when it comes to intent to purchase. Now, Dave, let's get to the all-important interest rates. The survey did say some interesting things. He's laughing because my script doesn't say that.
No, there's a couple choice words, shall we say, that Mike's added into that sentence.
The survey said some very interesting things.
Yeah, I thought you might have said them, so Mike could have used the beep button.
I'm hovering over it, Revy.
Oh, no, you dropped me under the bus. Anything for a few ratings.
One day I'll get you.
So, yeah, look, interest rates clearly remain, together with the difficulties caused in getting access to finance, and really that's one core reason is that our borrowing capacity is reduced by so much because rates have gone up by so much. But they're the two biggest concerns confronting the survey respondents. So when asked outright if interest rates would impact the respondents' decision to buy property in the next 12 months, so that was just the sole question, that figure had a steady climb, up 4% over the previous quarter to almost 46% of respondents saying it would have an impact. Borrowers are also more sensitive to the size of prospective rate rises, with a rapidly rising number of respondents saying a hike of 0.25% to 1% is enough to stifle their buying plans. So that was 29% of people said that. So look, overall people are worried that rates haven't yet peaked. And I think that's partially because after the initial pause in April, it seemed like everyone went out on the streets and had a party and were high-fiving and, but ultimately that proved to be a false dawn with the RBA then raising rates twice more in May and June. And I think once bitten, twice shy. I think people are a bit gun-shy and less trusting that the RBA won't raise rates again. So, they're waiting a little longer for clearer evidence that we've sort of reached the peak. So we've had 2 months of pauses since the last rate rise. And, from what I'm reading and the data, and I think there's mounting evidence that we are at the peak and there won't be another movement until 24. And it's just as likely that that could come down, which goes back to what you were saying, Mike, how this is potentially, the best buying time we'll see. Like every moment until rates reduce, the opportunity to purchase well is reducing.
That's interesting, though. I mean, it's good to talk about those who are cautious and are impacted by rates. I've seen the flip side of that, those who are fearful of the impact of a rate increase on their borrowing capacity. And they're the ones that are saying, can we buy something in the next 30 days? We've just had this rate increase. It's just filtered through. We're very, very nervous that we'll get priced out of the area that we want to buy in. You're not so much seeing that behaviour with investors, certainly with upgraders though. Anyone who's desperate for a family home, if they're confident that they can cover the shortfalls or they can cover any impact of increased rates going forward, or particularly if they've got savings in the bank, or maybe, one's been on mat leave or career leave and they're very confident that they'll be in a better financial position personally, they're the ones that are saying, buy something really quickly while we can borrow this amount. Let's spend our max while we can. The other thing I noted in this data is the decision to buy versus the decision to sell when rates have been hiked up is not broadly different except for the decision to sell. So we're seeing 28% are saying that their decision to sell is affected, versus 25% saying their decision to buy is affected. So we've seen evidence there that the people's holding ability has been in question with our rate increases.
I was just wondering, this data is showing that people are getting close to their limit, right? And Dave, if we go back to sort of the property boom where interest rates were around about 2%, people's serviceability was, an extra 4% on top, or was it 3% on top? Are we getting close to that point where the bank's serviceability was calculated on close to where we are now?
Well, now it's much weaker than it was prior to COVID. So the buffers are the same, but interest rates are, a couple percent higher. So it's harder. But one thing that my brokers have been telling me is that the serviceability calculators between even the majors are much more varied than they ever have been.
Right.
So the same person can potentially borrow 100 to 500,000 more or less with one major versus another major. Right. So that's I've never really seen that sort of disparity, and so that is really important to our listeners to consider. That if they feel like they could afford it, but the bank won't lend them that amount, they should be talking or looking at what other lenders will lend them.
That seems really weird, right? Because I heard someone tell me the other day that investors said to them, "Oh, I'm just going to go to the bank and see what they'll lend us." I'm like, no, you don't go to the bank anymore, right? It's not the 1950s where you had a relationship.
Impressive. No, you've got someone in offshore in a lot of cases having a look over whether you qualify based on just black and white assessment criteria.
Sometimes you'll hear people say, or brokers say, like NAB or Westpac or whoever, they're really looking to lend at the moment. I'm like, what do you mean?
Hello?
They're all banks. They're not looking
but
to
it's
lend.
true.
Yeah.
You know what they mean. You know what they mean, though.
They've got a heightened risk appetite as a result of lower profits, and they've managed to, let down the guardrail a little bit and take some less.
Their percentage of market share has fallen, so they're trying to get back volume and.
That's right.
And it does. It ebbs and flows.
It does. And what do they say when their profits are up? What sort of client do they want? What borrowers do they like?
Safe borrowers.
Vanilla borrowers.
Vanilla, yeah.
Oh dear, the broking days are far behind me. Happily, I don't know how you do it, Dave.
I don't do it anymore. That's how I do it.
Oh,
I have a
headachy.
great team who
you
do
do
all the wonderful work on at least the mortgage broking side of things.
Yeah, they do.
Yeah.
Mike, let's move on to the survey's question about the RBA. You've been supportive of Dr. Lowe on this show, yet the RBA is falling out of favour among respondents, and a troubling 47% of respondents gave the RBA a fail for having performed to a poor or very poor level. Personally, I reckon that's a bit harsh, but each to their own. The amount of respondents that gave the RBA a mark of average or above average was 54%, well down from the 61% of last quarter. Tellingly, the big shift was in the proportion that rated the RBA's efforts as very poor, which took off from 15 to 25% in the past 3 months. And conversely, a measly 3.7% rate the RBA's performance as very good. So are you, or about 300 plus survey respondents, wrong here?
Objection, leading the witness.
Beep.
Yeah. No, I mean, I appreciate the stab in the front, Cate. You're a very open and honest person. You never stabbed me in the back. But yeah, look, I mean, I wrote the notes and I called him Dr. Lowe rather than, Phil, right? Because I think he deserves a little bit of respect. And it begs the question, like, who is actually qualified to rate the skills or the prowess or the decision-making of the RBA? I mean, I don't really feel like I am. I don't have an economics degree. I don't have a PhD in economics. I'm just a bloke with a dodgy haircut, I think both the government and the RBA did a pretty damn good job during COVID, right? If we can go back and we can be critical, the government shoved way too much cash into the economy, and then we saw this massive boom, and we've got hyperinflation. Maybe not hyper, because we contrasted that to the German story of getting your pay and taking it and buying something straight away. But, I think it's just like rates go up, RBA bad. Rates go down, yay, RBA doing a good job.
But it's interesting that you talk about them putting too much money into the economy. I would have argued at the time that we really needed it, it was an absolute shock and it did stimulate. I wouldn't suggest, I don't feel that they put too much in. I just think they left too much running. They left the tap turned on for way too long.
Yep.
Yeah. Look, I think overall they've done a good job, and he seems like an eminently decent and intelligent human being. But I think there were 3 areas that has probably cost him in the fight against inflation, and obviously the PR fight as well. I don't think he should have said in November 2020 that the board is not expecting to increase the cash rate for at least 3 years.
What a crystal ball. Like, none of us could ever have worked out that was a guarantee. Never.
100%. Look, you just can't ever see beyond 12 months. And sometimes not even 6 months. So, look, I think he then doubled down on that a few times and said he didn't expect, the rates would remain at its current level until at least 2024. He said that again in March 2021. So I think that was one of the mistakes. I think, look, it was a once-in-a-100-year phenomenon. It was really scary. They had to make some big decisions, but they probably went too hard with the term. The second point, I think, was the term funding facility, where they gave the banks an extra $200 billion, and that guaranteed a really low rate of 0.1% to the banks for 3 years. And that's all the mortgage cliff now. That's falling off. That's all the funding from that funding facility, the TFF, from the RBA. So that's they've sort of created their own problem there. So I think they did too much there. And then the third one is, as you said, Cate, they were too slow to respond when the economy was recovering, when we had inflation. So a bit of an example is the Reserve Bank of New Zealand. They increased their first set of interest rates 7 months prior to us. We waited 7 more months than them. So, we're a bit too slow to act, and we're seeing the consequences, and that's, I guess, the taxpayers, the voters have decided a lot of them have given him a fail.
And isn't it incredible when you cast your mind back, and obviously it impacted the economy in lots of different ways and lots of different sectors and industries, but we're in the property industry. And if we think back to 2021, when property values were just soaring, and every time we did market update, it was, ridiculous growth figures, and we had double-digit annual figures very early on, and regions were flying. Money was so cheap. I know people were making changes. They were making lifestyle decisions in response to the pandemic, but we were able to do it because the cost of borrowing was so ridiculously cheap. Borrowing capacities were high, and we'd pretty much had credit free up a little bit after the lows and the woes of 2019.
The Royal Commission.
Yeah, we were just too slow. And I remember people saying, oh, well, rates won't increase for a while. But even factoring in a 2 or 3% increase on what we already had, for some people that would have equated to a doubling of their actual interest rate.
Yeah.
And they hadn't really thought about it.
But there's one of the stats that always stuck with me that I shared on the podcast, I think late 2020, was that 1 in every $3 in circulation, US dollars in circulation, were printed that year.
Right.
Yeah. That's just going to lead to inflation. And sure enough, it has.
Yeah. Well, moving on, let's talk about rents. In this report, there was an interesting infographic showing that there was a large decline in the population of landlords who said they'd be willing to lose a good tenant to pursue the highest possible rent return, down from 47 to 32% over the quarter. This could be attributable to a decline in the percentage of people who say they're under mortgage or rental stress. While still disturbingly high at 36%, it was an improvement on the 43% of the previous quarter. Disconcertingly, 79% said their financial stress status had eventuated over the last 12 months. Dave, the Greens have shared some comments that would leave us to believe that landlords will always pass on costs wherever they can. Do you think that's a fair comment?
Oh, I don't think so.
It's ridiculous, isn't it?
It's ridiculous. I mean, look, the vast majority of investors are middle class, mums and dads who are aspirational and looking to set themselves up for a self-funded retirement. So, they're not a liability to taxpayers and the government, and ideally leave a nest egg to their kids. They're decent people who appreciate good tenants and are willing to keep rents lower to maintain good tenants. Yep. And let's remember they're the largest provider of rental accommodation by a long way.
83% of all housing.
83% of all housing. 90%, based on the last ATO data, of all investors, property investors, only own 1 or 2 properties.
Yep.
And it's up at 96% are 3 or less. So the vast majority, they're not the mega rich owning lots and lots of property. And do we really want our residential property, rent market for renters controlled by major corporations and out of reach for the average mum and dad aspiring Australians? It's
a good question. And back to what I asked you, will landlords always pass on the costs wherever they can? Let's say, let's throw a devil's advocate question out there. Let's say we wanted to. Let's say Cate Bakos was no longer happy with the status quo. The interest rate increases have been a burden. The additional land tax is a bit of a bother. And I decide, stuff it, I'm going to implement some higher rents just to make sure I recoup these costs. Well, if I go above market rent, in a free market situation, the tenants will opt out of applying for my property. I can't hold a gun at their head and make them pay more. It is a free market. As much as we've got some of our rights limited as landlords, you can't just pass on those costs. You can only do so when the market will accept it.
Absolutely. And why does the market accept it? Because of the supply issues, which is back to governments and local councils not making it easy enough to provide new properties and the supply of new properties.
Yeah. There's a lot of chatter about rental cost increases, and it's true, right? The pace of change has been so rapid, but it's a long time of no movement whatsoever. And I've mentioned, I think, in a recent episode that Pete Kalizos basically highlighted some research to say that rents haven't paced with inflation. And this stat says to me,
so it's playing catch up.
Yeah, yes. And this stat flies in the face of the Greens rhetoric. It's 68% of people are not prepared to lose a good tenant to maximise their returns, and you can't pass on all the costs because the costs for landlords have risen so much faster than they have for tenants, but nobody talks about that.
Yeah.
No.
Yeah.
Well, hopefully today they are.
If they, I mean, if they have debt on their property, and let's say it's 80% or more, yeah, the cost for holding the property is increased faster than the return from the rent.
Yeah, very true. Well, we've talked about the Westpac Consumer Index consumer sentiment figures on property recently, but this survey highlighted some different views. Respondents believe that there's plenty more upside in the property market, with 72% expecting property prices to increase nationally, while 55% believe regional property prices will increase also. Yet, when asked for an overarching opinion on the current state of the Australian property market, fewer than half of respondents, so 49.8%, had a positive outlook, but it was still 6% higher than last quarter. Only 20.3% said they felt negatively, which was down 8% from the previous quarter. Mike, does it look odd to you that the predictions are 71.8% saying an increase, but only 49.8% are seeing a positive property market sentiment?
Got to be careful here because I've scripted myself in a tricky way as well. I don't normally do that. Yeah, what is kind of weird to me is that the investors in the survey are saying 71.8% are saying that prices will go up, yet only 49.8% of them are positive about the Australian property market. So to me, that can only be I'd buy if I could, but I can't. Or I'm too worried to. That's the only way for me to reconcile the difference.
And you pitched that in our consumer index conversation a couple of episodes ago as well. In fact, I think that was the exact quote you used.
Yeah, I mean that's what Mike said, and it's been going on for a while, hasn't it? I mean, because of that disparity between time to buy a dwelling on the index versus price expectations, which is sort of similar to what is happening here in these responses, isn't it?
Yes, very much so.
Look, there's a real battleground at the moment with the Senate inquiry into rents and affordable housing, isn't there? What do you think, Cate?
Yes, I'm reasonably displeased with the Greens policy at present.
And why is that?
I feel like we've got to let people behind the curtain, and I need to be upfront here. And even though I'm 41 years old, I'm a father, I run a business, I'm still very immature.
Oh, there's a whimsical side to you for sure.
And when I sort of script my episodes, I like to sort of just do them, almost like the guys can kind of read them out just to see if they will. And I throw some Easter eggs. And because Cate is so polished and she never says anything naughty, there's a few F's and Jeffs I throw in there because I'm just exhilarated by the fact that she might say one of them, live on air. She never does and never will.
You can say it for me because you've got the button. So Dave basically asked me what I thought of the Greens, and you can roll with my script, Mike.
Yeah. Kate's script was the Greens. And whilst you're not going to say it, I think we've got to talk about the Greens because I don't think it's unfair or like we're going to get too much hate mail to say the Greens have got it wrong on their housing policy, right?
I just want to know when they deviated from environmental policy to becoming socialists. I don't understand when that happened.
Yeah. Well, I like to think of myself as an environmentalist, and I do really care about the state of the planet that we're leaving for future generations. I care about the balance of a free market economy and protecting some of these treasures that economists will put a value on, but I think are beyond placing a value on. But there isn't really a political institution for me to pitch my flag that has sensible policies around housing and the economy. So it's a sad state of affairs for me.
Yeah, it's very true.
On the front page of the Fin Review today, at least, it did say because they're having the National Cabinet and the supply crisis is at the sort of top of the agenda. And thankfully it did say that even Dan Andrews has now agreed that they won't...
freeze rents.
Ruled out, freezing
for
rents.
2 years.
So that was good to hear.
Yeah. And it's interesting that people say, oh, well, we can't even freeze them for 1 year. We essentially have. I mean, in our state, we can't put rents up twice in 1 year. You get one opportunity to do it.
Yeah.
So let's look at the top concerns for investors. Dave, do you want to run us through these on the ladder?
So the top concerns was 12% finance. So people are finding it they can't borrow as much money as they would like because serviceability skyrocketed. Interest rates, so that was 11%, just under finance.
Yeah.
Affordability, 10%. Now you could sort of lump these three in almost the same category. So really that's 1 in 3 is worried about either, the cost of the finance or accessing finance. But beneath that, rental yields, which is interesting because, and I think it goes to what we were talking about earlier on, 9% are worried about rental yields. Even though rents are rising so much, the yields are still not great historically relative to the values of the property and also relative to the cost of the debt as well. So you've then got availability at 9%, so that talks to the supply problems. Inflation, cost of living, which you could sort of lump into affordability, so that's at 8%. So then you've really moved up to 4 out of 10 that are worried about affordability, interest rates, inflation. Fluctuating prices at 7%, which is an interesting one. What do you think about that and people's mindset who say that's a concern for them?
I think they're the ones that want to time the market.
Yeah.
Or they could be trading and they're nervous about not being able to trade in the same market. When I say trade, an upgrader or a downsizer, they might be worried about getting a miserable price for their property when they sell after they've paid a premium to buy. It's always a concern for people who are trying to time a purchase and a sale.
Yeah. Yeah. So 6% the rental vacancy rate, which I don't quite understand that given it's so low.
Yeah. That is weird.
It should be a positive. Land tax, 5%. That's certainly gone up in some states. Victoria had the fear of God put into everyone who owned an investment property in Queensland last year. The impact of the global economy, 5% building costs. That's very understandable given they've gone through the roof at 5%. Worried about maybe taxation laws changing, 4%. Stamp duty costs, 4%. Quality of construction, 3%. So that's, you can understand people particularly looking to get into a newer apartment. And then 1 out of 100 were worried about foreign buyer fees, which suggests 1 out of 100 foreign buyers.
Yeah. Well, I would argue there's more foreign buyers than that, and a lot take it in their stride. But yes, it is an interesting figure.
Yeah.
So on the rental yields, which were in 4th place, there was an interesting graphic on what investors think is reasonable. Mike, what can you share here?
Yeah, there's a lovely little infographic that says that the greatest cohort of people on the survey, which was representative of 27%, said a satisfactory rental yield is between 4.6 and 5.5%, which, as Dave mentioned, is probably on the higher side of what you could expect, certainly in places like Sydney. Good luck to you unless you own a boarding house or something like that, a commercial property. So if we take out sort of like the median, we're talking somewhere between 3.6 and 6.5 as the sort of sweet spot for investors in where they want their yields to be.
Yeah, very much a fact, which I wonder how the investors that are investing in our major cities, particularly our low yield cities, feel, because I often talk to interstate people and they seem quite comfortable at the idea of 4 to 5%, and I have to say to them, you will not get that in Vic. You might get 4% for an apartment, but very, very difficult in the capital cities, certainly Melbourne.
Yeah, Melbourne and Sydney are really right out of that target band of people there, aren't they?
Yeah.
And I think that's
9%.
another... Sorry, Dave. I think that's another reason why houses, as being popular and yields, people wanting them around 5%, it's pushed people to invest in places like Perth, which we've sort of shown has been pretty popular. In the capital cities, if you want a high yield in Sydney or Melbourne and you want a house, you need a lot of money and you need to be able to support a negatively geared property.
Yeah, 100%.
Yeah. Okay, so now that we get to investors' purchasing intentions, we can see from the data that we've got a declining number intending to buy in the next 12 months, and we've also broken it down by state. Is Queensland being so high a surprise to you, Mike, given the episode that we did on the Queensland land tax changes?
Yeah, we talked about that 98-day period where the land tax change was legislated and, people wanting to buy in Queensland kind of fell off a cliff. But we're still talking at the bottom of that cliff. It was 33% of people choosing Queensland above any other state. So in our data, Queensland in the last couple of years, you could probably say 3 or 4 years, has been more popular than any other state. So it makes sense to me that remains. I just think that tinkering at the margins with the land tax changes that eventually was repealed, that put a dent in it. But still, the popularity of Queensland is there to stay. And Dave, when it comes to places like Perth, I wanted to ask you the question. It's booming outside of places like Sydney and Melbourne. Because there's a really good infographic saying, where are people wanting to buy? And Queensland's very popular, but outside of the typical eastern seaboard style places, Perth is really booming. Can you sort of point to any particular reason why that's making sense?
Yeah, look, I think it's a timing factor. I think it's been flat for so long, 10 to 15 years. People can see that it's relatively affordable compared to many other capital cities, and so they probably feel like it's time for WA and Perth in particular to shine and rebound. So I'd say that's enticing a lot of investors. I'd say the relative yields of rental returns are quite strong. I'd say that also because that border was shut for such a long period of time, I'd say there were a lot of people who were probably trying to buy there or wanted to move there or wanted to buy an investment property there. So there's probably a bit of a catch-up that's taking place for people who couldn't transact or act or weren't willing to without being able to visit or move over there and then buy the home. So I'd say there's a bit of pent-up demand feeds into that picture as well. So there's some of the factors that come to mind.
Yeah, interesting. So when it comes to purchasing, the proportion of survey respondents making a purchase in the next 12 months as investors still remains unchanged from last quarter at exactly 50%. A couple of years ago, this figure was around 75%, and overall 25% indicated they planned to buy a residential property, up 22% from last quarter, while 12% are intending to sell, up by 2%. A further 17% plan to build, subdivide or renovate.
Yeah, the data is showing some interesting purchase types too. So in terms of preferred purchase types, it's detached houses at 36%, townhouse, villa at 20%, unit, apartment 19%. 1 in 10 are considering a commercial property. 8% vacant land, you imagine, to build a home on predominantly. 5% rural, so farm or hobby farm, etc. And so there's a bit of that sort of actually, those numbers, you'd say probably commercial property seems a bit higher relative to the overall population, 1 in 10.
Yeah.
It's not surprising townhouses being 1 in 5. I think in the last census, it was potentially the only property type that increased as a percentage of properties across the country. So, I think townhouses are going to become more and more prominent, particularly in locations that have been harder to get council approval in. Where and does anything in those numbers jump out at you guys?
Look, I'd be really keen to delve into the commercial asset figure at some stage in another episode and just explore what the breakdown is of investors who own commercial assets, because I sense that it's very, very different to resi, where we have a large proportion only owning one or two. I think the slice of commercial investors is very different, and you have some very wealthy commercial landholders who have multiple properties.
Yeah, I'd agree with that. And then often they're owned in syndicates as well.
Yes.
So it allows them to purchase multiple properties or have a share in multiple properties.
And the deals that you can get at those higher price points. I was talking to a commercial buyer's agent the other day, and he basically said over and above 3 or 4 million, you can access deals that just have far better fundamentals, and all very well if you've got $3 or $4 million to spend on a commercial property that doesn't represent a big chunk of the population. But it's the same as with development, right? If you want to build 3 townhouses or if you want to build 100 units, there's a huge lack of competition in that 100 units because there's only a certain amount of people that can fund that. So a syndicate is a good way to get yourself into that rarefied air where there's not that many people that are transacting there, and they could be institutional investors like fund managers or real estate investment trusts, and sometimes they're just not on the buy, a bit like the banks. They're not lending right now. These guys aren't buying right now, so there's opportunities there.
Yeah, so true.
Exactly.
Now, in the interest of not getting penalised for running over time, we've done another mega episode here. Mike, it's been a fantastic distillation of this survey, and I love your work, and I didn't get baited, to swear. It's been great to see you too. I think we've got to delve into commercial at some stage with a bit of a cross-section of commercial landowners. That'll be a good one for the future. But until then, I'm going to sign off and say cheerio. Just see you. I'll see you guys next week.
Cheers, Cate.
Have a great week, Cate.
You too.
You too, Mike.
Now it's time for us to go mining for our gold nugget property tip of the day.
I think my gold nugget is this disparity of people saying that they're positive about the property market and that they're looking to purchase, right? So it's saying to me that if people could purchase, they would. So my gold nugget is if you're in a position to purchase a property, like Dave mentioned before, now's the time to do it. Don't wait. Don't try and time the market, because when interest rates come down, and they will, there'll be a lot more competition. And we're seeing some listings coming on now, so it could actually be the best time to buy a property, and who knows, maybe the next 5 to 10 years. I'm sure I'll regret that in a later episode when we dig it back up.
Yeah, look, I think that's a great gold nugget, Mike, and mine will be linked to that, I guess. Ultimately, if we look at a lot of the things that are putting people off buying, it's external factors. And ultimately, I have a saying that the most important economy is your own personal economy. And if you're clear on your own personal economy and understand your own cash flows and have built in a significant enough buffer, then what's happening externally shouldn't matter, and you should be able to make decisions in your own time frame and not be trying to time the market, which is often an excuse for actually being fearful to make a decision. And often that fear comes from not having done the preparation and planning ourselves to feel confident that we can afford to take the step.
Love it. Yeah, I couldn't agree more. Well, that was a show. See you next week.
Bye.